edition of the Insurance Experts. I'm really excited to have my friend Dan Heffernan on the line. He's an expert in the business owner long-term care market. First of all, Dan, tell me a little bit about yourself and how did you get into this business?
Well, I actually got in the business when I was in college. So 40 plus years in the business. Started out as a disability specialist and actually had not only sales responsibilities over that part of my career, but also claim responsibilities. And then about 25 years ago, was able to transition to the business owner, long-term care concepts, and have been doing that for quite some time, specializing basically just with business owners at all different levels of types of businesses, whether they're law firms, manufacturing firms, one-person sole proprietors in that particular area, as well as showing them how to navigate this, because every single profitable business owner should be doing this for themselves and their spouse.
So I know you recently worked with a client. Can you tell us a little bit more about that case that you had worked on?
Well, one of the cases that's common, and this one falls into that place, we got a 3-person ownership basis that are 59, 55, and 53 with spouses, doing well, been in business in excess of 25 years, and they have dealt with long-term care experience firsthand with their parents. Typically, it's mom, and in their case, that's what it was. And they didn't realize how expensive it was, how time-consuming it was, and that they could actually plan for it now in their business and be done with it by the time they quit working.
What kind of business?
They were manufacturers, and about 200 employees total in the company. So a lot of diversity of what they do, but we were looking at taking care of the business owners. And in the business owner long-term care arena, in January of '97, HIPAA became law, and it said that you can discriminate in favor of highly compensated owners in a business. That's the exact language they use, highly compensated. So we can carve out just the business owners. Well, what chap's usually a business owner?
Right. So how did they become aware of this opportunity? How did they come up on your desk?
Actually, the agent brought it to me as their client. He'd been working with them almost from their inception, and handled various products. Very, very high functioning life insurance agent. Great company he's with, done a great job, but this was an area he did not have any expertise, and he needed that expertise that I bring to the table relative to business owners, how to craft it, how to navigate all the issues, and do it the right way.
So tell us a little bit about the strategy itself. How does this business owner insurance strategy work?
Well, first is we recognize that we can discriminate. Now, what we really want to do is, what's counterintuitive maybe is that, wait a second, long-term care, I'll buy that when I'm 70 because that's when I think I'm going to need it. That's why nobody's really ever heard of doing this. Because we want to buy it during your high income years, be done with it by the time you quit working. So that it's truly a walk away executive fringe benefit. You actually take it with you. You own it day one. It isn't owned by the company. You own it. The company is a premium payer, just like health insurance. And it comes under that category. So they're able to procure this benefit when they didn't even know it was available, to be able to handle this need that may be 20, 30 years down the road.
What's the added value of doing it as a business owner? Is there a tax deduction or something like that available for them?
Absolutely. There is a tax deduction. I like to call it a subsidy. It's not a tax credit. It's a deduction. And it varies depending on how you're structured. If you're a C Corp, it's 100% deductible, no imputed income. If you're a pass-through entity, it's partially deductible because it is imputed income, and then you have a value of what you can deduct, and that's established and it increases each and every year, and it's a pretty substantial amount. So you do get a subsidy from Uncle Sam. And keeping in mind, as a business owner, we generally don't get a subsidy on anything. Usually it's a progressive, we want more. Here's one you actually get a benefit just for yourself.
And what happens
It truly
when
is
you
a no-brainer.
share benefits? Is there a tax? Is there taxation at that point in time?
No, it's treated just like health insurance. We don't think of health insurance that way. We think of health insurance, let's say I pay a premium and it pays the bill. You're actually getting a tax-free benefit on your health insurance. Long-term care gets the exact same treatment in the tax code. It is a tax-free benefit. So you got the deduction, just like health insurance, and then you get the benefit tax-free.
So what did you end up designing for these three business owners and their spouses in their long-term
So what
care
we
plan?
looked at, first we looked at the health, see if they could qualify. This is not something you can just go get it at the local, Walmart. You have to qualify. It's a pretty high risk product for an insurance company because most people will tell you one parent needed it, one parent didn't. We don't have to come up with some weird hypothetical. So it's a high probability you're going to use it. What we wanted to do is come up with a plan that is fair to three different owners who have different ages and have different insurability. So what we did is a money purchase plan, which means we achieved a number that we were going to pay for each individual or each couple, actually, let's be specific, so that if we don't want a plan that has one premium that's double the other person's premium when they're equal partners. So we achieved it was a $10,000 premium, but I'll qualify that in a minute, I hope. $10,000 premium for each couple. So that's covering 6 people with $30,000 of premium, and we've designed it with what's called a 10-pay, where you pay it up in 10 years. The first question is, well, why would you want to do that? Well, I want to use the tax code through the business as long as I can, and I want to go through the full 10 years on Uncle Sam's nickel while we're doing this.
Well,
so
actually, I had another question for you, which is you said there's 6 people covered, $10,000, but the total is $30,000. How does that come about?
$10,000 per couple.
Oh, I see. So you did like a joint plan for each one of them.
Right, and it's a money purchase. So if a person has younger, they may get a little bit more benefit because this is not specific to plan design. Everybody has to have the exact same plan. Each individual designed it to their own particular risk management needs. One could have a longer elimination period or a shorter benefit period with more benefit up front. This wasn't a cookie cutter, everybody's got to buy the same thing. They can literally design it to fit their particular needs and philosophy of risk.
Right. So what type of business did they have, and what was the tax deduction worth to them?
Well, in their case, they were in their 50s, so a large portion of the premium, more than half, was deductible. So let's assume each individual had I don't want to get into specifics of their income. Let's assume each of them make $100,000. And the firm paid $10,000 deductible to the firm for this health insurance benefit. So it's imputed income to them because they were an LLC, a pass-through entity. Then they would have $110,000 of taxable gross income. Then they get an above-the-line deduction on their tax form Schedule 1, line 29, that's based on their age. To achieve their adjusted gross income, it does not get a deduction under your medical Schedule A deductions. This is what we refer to as the above-the-line deduction, not a medical deduction Schedule A.
So they got a significant partial deduction from using the benefits from for the premiums, but also the benefits are still tax-free. So obviously you can work with a lot of different business owners on this strategy. Is there really any limitation? It sounds like most businesses can qualify for this. Are there any qualifiers about who can do this?
Actually, it's unlimited. You just have to be profitable. Uh, we've done nonprofits,
Mhm.
then it's 100% deductible. We've done major law firms, CPA firms, manufacturing firms, dentists, professionals. Uh, Anyone is eligible. You don't have to be 3 or more or 10 or more. It can be a sole proprietor. A farmer can even get this as a business deduction. Anybody that's got a small business is eligible. Every single profitable business owner really should be doing this for themselves and their spouse, and they don't have to do it for anybody else in the firm.
Wow. And there's probably something like 30 million businesses out there. So there's probably a lot of people that can take advantage of this. I'm sure we'll have you on for future episodes to talk about some more case studies. But thank you so much for sharing this case. And again, we look forward to the next edition when we talk about some other business owner strategies with you.
My pleasure, and thank you for having me.